G'day traders, before we get started, do me a favor and hit the like button and the subscribe button and turn on your notifications. That way you'll be alerted when a new video is released. Thanks for doing that. I appreciate your support. Let's get started. G'day traders, Stacey Burke from Stacey Burke Trading. Today we're going to be talking about selling high and buying low. Last day we talked about hindsight is not a strategy, and planning, preparing, and executing your trades. And the emphasis obviously being on understanding exactly the three main things I'm targeting are always the timings, the high and the low of the day, round numbers, and behavior of price at those levels. And today we're going to hopefully dive in a bit deeper, and again, just answering a lot of questions, hopefully in the video, a ton of questions, a ton of emails, and I apologize if I haven't gotten back to you, but I just literally have been inundated. I was on Trading Nut podcast interview, and many of you saw that. And since then, I've just really had 100 of emails a day. So again, trying to get through them, juggling everything else. I got 3 kids and sport and everything else, as well as trading. So today, just again, I'm gonna really just keep repeating the process, but we're gonna review multiple markets today. Maybe split this into 2 sections, and we'll look at the different scenarios on different markets, because I keep getting the main question I keep getting over and over from a lot of people is, that's great. Can I use this on this market? Can I use it on this market? Can I use it on crypto? Can I use it on the euro pound? Can I use it on the S&P? Can I use it on shares and all these things? So we're gonna hopefully answer those questions. And again, just before we get started, I just want to thank a ton of great feedback, ton of awesome screenshots. Literally, a lot of traders, I think, number one, it's halted perhaps a losing repetitive pattern. We're going to talk about some things with relation to that with behavior as well today. And traders starting to see some results and getting the bigger picture of what's actually happening. So coming back and honing in on a simple concept, it's retail versus the smart money. It's a zero-sum game. There's a lot of stuff on the internet that I think misrepresents stuff on shorter time frames. I'm going to talk about what I do. I'm looking for primarily 1 to 2 trades max, usually per session, and usually as the day evolves, I'm looking for one or 2 bigger trades as we head into the London or New York session as the range of the day has expanded. So just to come back and hone in on that, every market is the same. Every instrument has its own personality and volatility and behaviors based on the traders that trade that market. So there's a high and a low. So I love when I get comments from people about, that's hindsight, or, do it in live time. I don't know how much simpler it can get. There's a high and a low from the previous day. That's where it starts. So I don't know if that, you're right, that is hindsight. There's round numbers. I get this question a lot. What do you mean by double zeros? Every instrument has a price. Your trading price, it's 100, 25, 50, 75. I don't know how much clearer that can be. It doesn't matter if it's an index, it still has round numbers. It has quarter levels. It could be on a daily chart. It could be 250, 500, 750, but it's still a quarter level. Major round numbers are double zeros and 50s. We have timings that are constant every single day. The Asian market, the London session, and the New York session. Asia, 8 to 11, will repeat this in again 3-hour windows, but I'm looking for primarily the equity hour. But if they are at the high or the low heading into that first hour, there may be a trade. As we saw last night, there are a couple scenarios on gold. We'll talk about that. But when New York opens, especially, once that session opens, if they haven't already moved the market and you are at the high or the low, chances are you are going to see a large move from one side to the other of the market, especially in indexes, gold, currencies vary depending on that instrument, but we may see a strong move again from 50 to 0 or 0 to 50, or again a quarter level to a quarter level. Behavior of price at the high and the low are constants, regardless of whatever market you're trading. So those 4 things are constant every single day in every single market. I don't know how much simpler that can be. There's no voodoo involved with that. There's a high and a low. There's round numbers. There's a timing window. And there's behavior of price when it gets to those levels. So again, having a plan, preparing properly, and then being able to execute in live time is a performance-driven skill set. So what I love about this is that, when you spend thousands and thousands of hours banging your head against a wall, and then slowly you can start to see what's happening, and then still making mistakes, but then stepping back, and instead of looking on the inside of the high and the low, chasing all these swings back and forth, step back and look at the outside. That's where the smart money's working. And then understanding when the timing windows kick in, if they haven't already locked in a high or a low, there may be a trade from the inside out, but that comes back to what type of day has the structure evolved? What did we come out of? Did we trade into yesterday's low and we're in a trend day today, heading into the next session? Or are we trading back and forth? I said this in tons of videos. There's only three things that markets do. They break out, they pull back, and they continue to trend. They break out, they pull back, and they reverse, a false break reversal. Or they trade back and forth inside of a trading range. So the live time setting, which everybody says, I want a hard right edge and everything else, that's all great. But everything is based on what's happened on the left, because that's where the money is. The money's up high or down low. And the market is going to go to one side or the other, because somebody has to lose in order for the big boys and girls to make money. So every day, again, is a unique set of variables, but there is a high and a low from the previous day. The current day will create a high and a low at some point. It can create it in the first hour of the day. As the day evolves, the trading range expands on most days, and therefore your risk reward increases. So a few months ago, I got a question about the euro pound, and the trader couldn't understand why they didn't get a successful, profitable trade. The whole day was inside of a 25 pip trading range. And so if you're buying inside of that range, thinking that you're buying something in a buy setup off the bottom or inside, you're now possibly in a 15 pip trading range, because you've bought 10 pips off the low, and it goes up 5 pips and then reverses, and it's trapped you in the middle. So anything inside typically is in the middle. So being patient and disciplined and knowing what you are looking for. So again, coming back to developing your understanding of what constitutes best trade setups, understanding which days are easy days or easier days to identify days that are going to be the highest possibility days for making money. So there are certain trade setups where it will be possibly easy to make money, meaning that you can sell high for a big down move or buy low for a big up move, where the market is going to go strongly and quickly without you being in any heat. Timing is everything. Again, just to repeat, Asia, 8 to 11, Europe, London, 2 to 5, New York, 8 to 11 a.m., and these are all New York Eastern Standard Time. The yellow area inside is the middle hour. Somebody asked me the other day, what is the middle hour? That is the equity hour. That's when the equity market's open. Now, I know people are going to argue about Asia, variations, everything else. I'm just telling you when those windows kick in. If you don't believe that, pay attention on the 1 minute chart. There are often first hour trades. And again, it comes back to depending on how that has set up from the close and heading into the open of the next day. But that hour may be the hour where it continues the move. They may establish a high and low in that first hour or expand the range. That second hour may be the catalyst, or where that market now makes its move or makes its commitment or establishes the other boundary for a reversal trade. Either, the first hour makes a high, the second hour makes a low. They hit the stops, they pull it back inside, and then they trend the market. So it may, in some cases, be a third hour trade. Somebody asked me recently again, do I have all the different time frames up on the screen? 4 hour, 1 hour, 15-minute, 1 minute daily, blah, blah, blah. No, I look at the daily chart. So I want to know where am I at this week in relation to the month? Where's the weekly high and low? What's the Monday, Tuesday, Wednesday setup look like based on last week? Have we broken out of last week's highs? Are we inside of last week's range? Have we broken yesterday's high or low? Where's the monthly high or low? Where are we at in that month in terms of the timing? Week 1, week 2, week 3, week 4. I've talked about this before. There's a timing cycle in the month. So again, are we up high? Are we down low? Then on the day itself, I'm looking at the 15-minute charts for yesterday's highs and lows, the U.S. session, the London high low, wherever I'm at. Which high and low am I inside of when the day starts? And so I want to know where are the main areas. And then, of course, the market tightens into a consolidation in many cases. So are we down low? Are we up high into yesterday's low or high? U.S. session, whatever that may be. But I'm using the 1 minute chart for entering once I've established my thesis of buying at the low of the day or the session, or selling at the high of the session. They may be jamming the minute, maybe working up into a high, but it may be a sell high setup scenario. If it's gone up high and I think it's a trend day, I want to be looking for what's my thesis for a buy low scenario? Well, obviously, into the timing window, I'm going to look for them to stop hunt back into that move or take me up high for a sell, which may be a sell into a long trade day, but it still may be in gold, especially a 50 pip move down before they lock in the low and continue the trend up. So there may be two trades in that particular setup. Understanding that the object is to be trapping volume constantly up high or down low before they shift the market, so the trade may be trapped above 50. The trade may go from 50 to 0, but they may be trapping volume above 50, and the sell may be up at 65 or 70 at the high of the day. So you may be selling up high because your thesis is that the market is now locking in the high, but on the 1 minute, but then the major round numbers may be going from 50 to 0 on that next move of the market. So often if there's a quarter level of trap volume, I call that a death line. Again, an expression I've learned from some traders in the States. The death line is once they cross there, all that volume is now trapped and the market will shift away, putting pain or losses into that volume that's caught above in that upper quarter or lower quarter. There are different setups, so it doesn't always involve a death line, but there are major round numbers where highs and lows can be stopped out for a loss or at a break-even price as well. So again, just looking at high and low of the session, high and low of the day, high and low of the session. Are they working into the low or into the high? We'll look at some very specific examples of this. And then, is this a trend, a reversal trade setup, or are we in a trading range? And again, engulfments and pin hammers at these levels. So I'm not looking for a 4-hour trend or anything else, but I am of the understanding that when a new hour opens, if we are down low or up high, and they haven't already triggered other time frame traders, we may now breach the extreme, so we understand the timing window that we may not have the high or low in place as that middle hour starts, because they may want to go higher to trigger 4-hour, 1 hour, end of day, 15-minute traders into the market, trapping them and then reversing. So again, I use my 1 minute chart at the highs and lows, looking for these entries, because we may get a 15-minute reversal, which turns into a 15-minute pin hammer, but the 1 minute chart has now already reversed. And at the close of that bar, the 1 minute trader is already in profit. So again, just understanding at the extremes, when we have our price behaving a certain way at the timing window, the 1 minute chart is where I look to see that confirmation, or if I still need to wait because it's not set up properly. So again, not getting in front of news. Is there news on the calendar? Is there no news on the calendar? If there's no news on the calendar, I'm strictly looking at how price behaves at the timing window. If there's news, then I may have to wait until that major news is released if I'm not already in a move, as news can sometimes act as a catalyst or a blow-off to complete that move. But if there's news there, I want to wait. And again, even if the market takes off and explodes, understanding that the market now may be going up high or down low, heading into especially New York, the New York Open may be the reversal at the extreme to come back into that move. So depending on where the week opens, again, it may involve other time frame traders, for example, weekly, monthly high-low levels, daily high-low levels, and this can happen at the beginning of a month or middle and the end, which is why every week can be different. Okay, we could already be in a breakout, a trading range, or a trending market. So it's understanding that on the longer time frame, the daily again, but understanding using the high and low. So just looking at gold this morning, again, stripping this back will take all these lines off, and I'm just going to talk about how I approach the market each day. So heading into the close of the session, we have a U.S. session lower high and a U.S. session higher low. The market then obviously proceeds to make a lower high where the market opens inside of today. So we have our consolidation. Our major round numbers are 0 and 50. So obviously at this stage, the market has locked in the high above 50. They're trapping volume down low. The market has gone up from the low into the high and then come down, made a low, locked in the high at 50, and traded back into the low that they established in the swing low. So again, we're trapping volume underneath at this stage between 0 and 25. We head into consolidation. The market breaks above and is working into the high as we head into our 12 candle window. So I'm not in here trying to figure out which way is it going to go. I'm waiting for them to breach one of these levels. So coming back to having these levels on my 1 minute chart and looking at price as it behaves. So we reverse, we form a low on the 1 minute as we head into the second hour. So the second hour opens up over here, and I'll just highlight that for people to see. Okay, so the second hour opens. We have our high, we have our low, we have our levels, we have our high and our low, which we know there are stops there. But I also know at this current stage we're only in a 25 pip range. So am I prepared to put on massive size on a move like this if there's a trade off the high or the low? Not really, because again, I'm inside of the real high and low. They've just tightened this up and coiled it. But I know as this tightens and coils, we are now potentially going to be in a move, because I know the Asian range typically will move 50 to 75 pips. I've talked about this, 3 levels of rise or fall, 25, 25, and 25. So as we head into our second hour, we have a first hour high and low, which I've said this as well. The first hour will often establish the high and the low heading into that middle hour. So it expands the range. Our second hour now goes up and hits the stops. We get a engulfment pin hammer at the high after stops have been hit. That's where we see the pin. So again, an example of where the market ends up and understanding the timing window. So we are now 5 minutes into the hour. They've gone up 1, 2, 3, and engulfment, dropped it down, went sideways, and continued that move. This market closed as a bear pin hammer down low. Now, I've explained before, when you are chasing price, the close of this market is down low. It's not at the high. They've made traders sell down low. That's the first clue. They're selling at the bottom of the range. That means they're getting trapped chasing the move near the bottom of the range. Now we also have a bear pin doji that formed our initial low in the first hour. So they make traders sell down low. So somebody sold the 15-minute bar down low thinking this is going to fall and keep going down. What we have here is a stop hunt down. Now this is obviously a 25 pip trade, and it's over very quick and fast. When we get to the low, what do we get down low? We get a bullpen engulfment reversal. Now, I haven't talked about this, but whenever I see a doji bullpen at the high or the low, I cut the tail off. So you'll notice the bear pin at the top. If I cut the inside tail off on both of those, we have a bullpen and a bear pin hammer at the extreme high and low between 25 and 75 essentially. Again, at the high and low after stops have been hit. So just to re-edify, this is expanding the range. But if you were going to buy or sell based on the 1 minute chart, it's at the high or the low. Now, this is not a trade. Neither one of these are trades that I took because I'm not interested in sort of hoping that I get a 25 pip scalp. Now, this was ideal. There's nothing wrong with that. But I like to let the range set up and expand to a 25 to 50 pip box before I'll take that trade. So now we have a scenario where the market has opened up and expanded between 75 and 25. The market then proceeds to come back down into the low. So we've traded into the low of the first hour. We've traded into the low of the second hour. And at 5 minutes into that hour, we get a bullpen hammer into the low of the original breakout. We have a break in structure, which forms the middle of our W. So again, the question you want to ask yourself, are they working down into the low? Or are they working back up into the high? Well, they've come back down into the low as the next hour has opened. And we can see that this market continued to move higher to hit our initial stop loss at the lower high of the U.S. session above 75. We are trading into last night's peak formation. And at this current stage, the market has still not locked in a high. We may still end up going another 25 to 50 pips up. Time will tell. We're near the end of our 3-hour window. We have a bullpen hammer on our 15-minute chart. So again, they've hit the stops on the upside, hit the stops on the downside, pulled it back inside, made a W, and a 15-minute bull hammer on the second side of that W for a 50-pip move up into the high. So keeping it simple, the high and the low, and an example of where the market has traded into the low after it's hit the stops. So it doesn't necessarily have to go through the low, but this is what happens when you get into a narrower consolidation. Sometimes the Asian range will be this sort of coil before it expands. And again, looking at yesterday as opposed to making a high and then making a low and then trading into the low into the open of the Europe session. So as we traded into the low, the market again had opportunities right down at the very bottom, but it's understanding the timing window is critical. So towards the end of that hour and the beginning of the Europe session, traders had the opportunity to get into that market between 65 and 75 before that market took off and exploded through the lower high, making our middle structure for the W. And again, understanding 3 levels of drop, 25, 25, and 25, and a 3-push pattern into a squeeze for an explosive move up back into the previous day's high. So high and low of the day, high and low of the session. Now we'll just talk about this while we're on gold. Last night, heading into the U.S. session, we'll back this chart up. The market gave us an engulfment in the last 15 minutes prior to the U.S. session window opening. So again, the market went up and made a high, and then in the last 15 minutes, traded up a second time into that high. We'll just put a box up here. Traded into that high. We had an engulfment. So again, before the market even opens, we had an engulfment and an M structure up high. Our engulfment was at 89. We'll just get rid of that. So our engulfment was at 89. And we'll just draw that in here, project it across. And then when the middle hour opened up for the New York session, that middle hour, just prior to the New York Open, 1 minute before the New York Open, the market pinned up into that high, which is this pin structure up top. So again, timings, middle equity hour up high, and there's our bull doji again, upside down bull doji at the high. And again, I mentioned I cut the tail off. That's a hammer with a tail at the New York Open up high, pinning into the engulfment. And on our 1 minute chart, we have a bar where traders can position themselves at the same price as the engulfment after the markets come up. So understanding, yes, the market's moved down 50 pips already, 75 pips, but it's broken the structure, and now it's come back up, hitting stops on the first mouse. But once it drops down the second time, our target is the low of the day. Same it would be as if it was the high or low of a session. The market has gone up high for a sell high setup, going all the way back down to the low of the day. Now, this happens several times a week in the U.S. session in gold. You'll see 100, 150 pip moves. Monday was a holiday. Friday was payrolls. Same sort of setup though, trapping volume below 50 for the explosive move up. We will see plenty of 75 to 100 pip moves in gold. So understanding the high and low of the session. People are trading stuff inside, that's great, but if you're on the wrong side or you get caught or they get jammed in the gap times, if the algo kicks in, that's when you can get yourself into trouble. So as the day expands, okay, the range expands, and then your risk reward increases in terms of asymmetrical risk reward. So if we look at the S&P, I only trade or look at the S&P market for the New York equity hour from 9:30 New York Eastern Standard Time forward. I do not look at it any other time, only because my thesis on that is that the market is going to move with heavy conviction when the U.S. market is open. So there's often quite thin volume. There's obviously lots of volatility in these timing windows, but the U.S. session, again, is when we're going to see, Monday again being a holiday, when we're going to see the U.S. traders, the U.S. players step into that market. And that's when we're going to see big moves. When you see lots of wicks and everything else, that's obviously a day where there's been major news release. But again, when there's a normal day setting up, we see the same pattern that we just talked about on gold. Bear pin hammer, U.S. open for 100 pip move straight down. So again, instead of trying to catch these swings and scalp pips, I'm focused on when is the market going to explode and make one huge move from point to point, 15 minutes, 30 minutes tops, and be out of the market with zero heat on that trade. Those are trade setups that I can scale up in size with conviction when I have a thesis that the market is poised to explode and move fast and strong to hit stops at the low or the high. So again, the move started off the previous day's low, went up high, worked into the high, trapping volume under our death line. Our death line in this particular case is double zeros. In the pre-market, obviously news related, they break through this payrolls, they pull it back, bear pin hammer, explosive move to the previous day's low. So looking at the euro, again, I'll just bring up the weekly separator. And we'll get rid of this blue line. People ask me every day about that indicator. I can't send it, so just draw them in manually. If you're using TraderView, you might not like my MT4. That's what I use. A chart's a chart. If you're not sure, you can't see, open up your trading view and look at the chart and draw your high and low. So again, payrolls Friday, we had our high and low. This to me just forms a massive rectangle. That high and low is a massive rectangle. So again, I talked about three things that markets do. They break out, they pull back, and they trend. They break out, they pull back, and they reverse, a false break reversal, or they're in a trading range. So when we see the market go down through the low, that to me is expanding the range. They're working the low. They're obviously not working the high, they're working the low. We have the previous day's low. They pull back inside. They've broken through the low of payrolls. Obviously, payrolls traders are stopped out. So now we know we have other time frame traders in the market. We also have traders the next day trapped down underneath of the quarter level at 75. And they've traded back up in Asia and made a high of the day. Well, you'll notice that high of the day in Asia. So just to clarify, this is before the Europe session opens. So I would never even look at the euro in Asia. Yes, there are trades in Asia, but I wouldn't look at it. I just, if it moves in Asia, then I'll already have an idea of what I'm looking for heading into the Europe session. But predominantly, again, I would be looking at the euro or most major pairs, unless we're at the high or low of the week, probably in the U.S. session, because again, as the day expands, so does the range. So you'll notice we came back to Monday's high. So they've broken Friday's low. We've triggered other time frame traders. So somebody shorted the break of Friday's low. Guess what the market's done to them? They've triggered breakout traders. They got people shorting this down low. Now they've pulled it back. They've traded above the U.S. session high. So again, a smaller rectangle inside of a larger rectangle, a pattern within a pattern. Now they've got people trading long into yesterday's high before pulling back, hitting stops on traders that are long, hitting stops on traders that are short, into that peak formation high, dropping down. So again, trading range back and forth before breaking down in the U.S. session and dropping lower. So is this tradable? This to me is nothing ideal about this, but if I was trading the euro looking for a 3-day setup, we talked about first red day, all those types of things. So if we had a week up, we have our payrolls is basically one large doji. Our first red day is Monday. First red day is Monday. They trade up and put a peak formation, and I'm looking for a sell high setup. A sell high setup. Pin hammer at the high of the day. Is this an ideal setup? For the euro, it probably is, because the euro doesn't really move that much. But as I head in now to Wednesday, I have day 1 down, day 2 down. After payrolls, we have a breakout now of a large rectangle. So I have a high and a low, looking for one full range expansion as a possible trade, as a target of where this trade may be heading if I get a sell high setup. So again, people have asked, is that a fib tool or anything else? This is just 100% expansions. I've marked off 50% in that box, but it's 100% expansions, that's it. But if I'm in a sell setup, so again, trend traders might be using EMAs and everything else, I want to be selling high. So if I'm not trading in Asia and I come in Europe and I'm looking for a sell high scenario, they've expanded the range downwards. They come up 1, 2, 3. So we'll blow this up because I know people will send me nasty emails saying they don't like MT4 and they can't see my charts, and chart's a chart. So get your charts out and mark off a 1, 2, 3 at the Europe, third candle of the London session, the middle hour at the high, hitting stops on lower highs, traders that have chased that move down, and we're in the upper part underneath 50 into the peak formation from the Asian session. So again, the high bull is trapped. They've pinned up into that, and now we have our move down. So again, this is an example of where gold may be 50 pips. The euro may give 20 to 25. So they've gotten part of the move down. We come into the U.S. session, and it continues that move in towards the end of that 3-hour window before locking in the low and heading into consolidation. So high and low, breakouts, pullbacks, trend continuations, 3-day setups. Now we're heading into Friday. And you'll notice that the U.S. session yesterday was broken, so I get our midweek reversal possibly. So day 1, day 2, day 3 down. So Monday's our first red day, Tuesday's down, Wednesday's down, Thursday whipsaws back and forth, typical level 3 behavior. They hit the stops on top. So we get the high of the day, higher high, and a higher low, and they hit the stops on the low of the day before pulling back and going into consolidation. They have now made a low of the day in Asia and a bullpen hammer, taking out the lower high of the day. Is this possibly going to be a reversal day? I don't know, but at this stage, they have put a peak formation low in. We have a midweek reversal possibly setting up. It's a first green day. We have a close above the open. So first green day after 3 days down into a peak formation. We have yesterday's high, and we have news on the calendar tonight. We have low-hanging fruit at 50. It's possible we may see a move or a retest back up into the lower highs from the move down. We have creeping trend down. This forms fuel. We've broken the high. We've broken the middle structure. At this stage, it depends on how price behaves. If they were to roll down towards the low of the day, well, obviously that negates that. But if they breakout pullback and we get some sort of move continuing that long trade in the Europe-London window, again, maybe back into the quarter level, or a move up, triggering breakouts and then pulling back, working into the low, and maybe a U.S. session trade back up. But this is day 1, day 2, day 3, midweek reversal, first green day, and now we're looking to see what happens. And just also to highlight, if this market was to head up, our death line in terms of number level would be the quarter level, 25. We got volume trapped underneath the 25, and we've got a high of the London session just above that. So again, we got volume trapped underneath after a move down. It's not a massive move down, but again, this is typical day 1, day 2, day 3. So we'll see how price behaves heading into the London session. So the pound was ideal in terms of the opportunities that have come up. And again, I talked about payrolls often being the beginning of a possible 3-day pattern. Same sort of scenario. We have a high and a low from the payrolls Friday, because Monday opens up inside and gives us our first red day. First red day after a move up. So we had day 1, day 2, day 3 blowing off in payrolls. So 1, 2, 3 up, payrolls goes vertical. Monday's a creeper down again. Monday, Labor Day weekend in North America. So not necessarily traded by anybody. No trading in the U.S. I traded in Asia and then realized I forgot it was a holiday and couldn't tell why the movement was so tiny on gold. And then I found out, of course, I forgot it was Labor Day. So coming back on Tuesday, though, immediately they go up and hit the stops on all the low-hanging fruit. So anybody who is caught trading this down in what they creeping trend, they go vertical right away to get traders who are caught down low. You'll notice that very little trading, and then Asia drops below 50, so the bulk of the entire day is below 50. Where do they go right off the bat? Up above 50. So they go up above 50, they hit the stops. I'll blow this up so, again, people don't get all cranky. They blow up and go above 50. They pin into 50. They drop it down to the quarter level at the beginning of the session. Boom, they go vertical and hit the stops. So again, just understanding that if you're in this trade, the window of opportunity when they come on board is not necessarily trading into the stop hunt, but if you were to trade this, understanding that this market can fail trading into the short trade. And then there's a pin hammer, so I'm not even going to go to the shorter time frame, but understanding again the numbers, they pin up into 50. We look at the 1-minute chart. Again, the first hour makes a low, creeping trend up. This is your first clue that they're going to go vertically. They make these pin hammers, creeping trend on the way up. These become stop hunt areas for the move down. So for all you people who think it's hindsight, do this 10,000 times and then see if you start to see the same thing over and over again. And maybe that will help you in lifetime. They hit the stops in the third 15-minute bar. And 5 minutes before that 15-minute bar closes, they reverse and give us our engulfment. Now, when this bar closes, this becomes a pin hammer on the 15-minute chart, which is what we're looking at here. So understanding what I use the 15-minute charts to see my levels. When they're down here and they start coming up, I'm looking on my 1-minute chart for the sell high opportunity. So we're not blindly jumping in front of something, and we're not selling down low. We want to sell. If this is a sell setup, I want to sell high. If it's a buy setup, I want to buy low. So the market then proceeds to break through yesterday's low, coming back, and again continuing that move into the U.S. session. So we're down low as the 12-candle window opens. So now our thesis may change, because now we're in a situation where they brought us down low into the quarter level, and we're trading into double zeros. So if this is a scenario where we're looking to sell high at the U.S. Open, again, we may understand that this market can fail at the low of the day, at the low of the beginning of that session. So there's a pin, but there's also the low of the session that this market may fail at. So again, a 25 pip high low. It may be perfect on the 1 minute. So coming back to the first hour, now this market has gone down low and locked in a low, gone up and came back down into the low. So I have no problem going long, buying low into an a downward moving market. Now this little bullpen hammer is 3 minutes before the New York Open at the low of the day. I will buy this. And we also have a break in structure. So again, we have lower highs and then then we get our break in structure, a higher high. Creeping trend down. This creeping trend is what will give me fuel on the way back up. Why? Because there's traders shorting this down into the low, putting stops above these highs. So again, look at any chart. It's the same thing. It's the same thing in Europe. It's the same thing in Asia. I want to see a creeping trend. I want to buy low or sell high. So we'll look at a scenario where, okay, we're in a 25 pip box on the pound. Creeping trend. They make a low inside of the low. Look where the pin hammer is 3 minutes before the New York Open. I'm going to hit this trade. But I also understand that this market can fail at double zeros. And we also have lower highs that were made underneath the double zeros heading into the session. So I'm targeting this area as my exit point. The market explodes up, which is what it's supposed to do. So a creeping trend, if this is a great trade setup, will explode vertically. They put in a high of the day. I am exiting once the market gets up to this high on its way to double zeros. So this is the false move at the beginning of the market open, back up into the double zeros. Again, you'll see the same pattern. Okay, we got it's about the levels. We have a bullpen hammer at the bottom. We have a bear pin hammer at the top. And then again, understanding the timing cycle. That is the first candle of the third hour. The first candle of the third hour. This candle is 3 minutes before the equity market opens. At the low, creeping trend down, third push to the bottom. 1, 2, 3. Bullpen hammer. Should it explode through? Yes, it should. If it doesn't explode through, then I'm either in 1 or 2 minutes early or I'm wrong. And I've got a small 10 pip stop at the bottom, a 10 pip stop at the top, and this market should go back. And again, our death line is the bottom of this market. If it's going to be a measured move, it'll go right through this market. What does it do? It forms a W at the low of the day. We've had 25 up, 25 down. This isn't now heading towards the end of the third hour. I'm done for the night if I was to stay up and trade that. So high and low, you can buy low in a downward market. You can sell high in an upward market, but it's about the levels. If you're using a 15-minute chart, you end up chasing the move unless you buy low in terms of there's the bear pin hammer at the bottom. Okay, and you could be using a 5-minute chart. So I cut the tail off. There's my bear pin hammer at the top. You would have ended up chasing this bar down. So again, understanding it's about the level. My level is double zeros and 75. I'm looking to, if this is a buy low scenario, I want to be buying at or better than 75. And if I'm selling up top, if it doesn't get there, I want to sell as close to double zeros as I can after they've cleared out those lower highs on the smaller time frame. So really important, regardless of the instrument you're trading, when you have identified your levels, it's about how price behaves at those levels. 4-hour trends, 1-hour trends, all that stuff is what it's going to end up making traders do is chase movement often, and you'll get some that trend. But then there's other scenarios where you're getting caught inside and you're chopped up. You can't figure out why you got stopped out or why you didn't make any money on that trade, or it went 5 pips and somebody else made 50, whatever that may be. So identify your levels and then look for how price behaves once it gets to those levels. Is it working into the low? Is it working into the high? You can buy low in a downward moving market. You can sell high in an upward moving market. You can sell high in a downward moving market, and you can buy low in a strongly moving upward moving market. So hopefully you got value from today's video, traders. Identify your levels, understand the timings, know where your highs and lows are at, understand the pattern of the trend in terms of the weekly template, day 1, day 2, day 3. Are you up high? Are you down low? Keep it simple. Look for the best asymmetrical risk-reward opportunities. Again, as the range expands, so may your opportunities, depending on the instrument and the setup. But keep it simple. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, The 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.